No Christmas cheer on Dalal Street as the markets fall for the fourth straight day, records its biggest losing streak. In close to about 3 months, the Nifty and the Sensex see its biggest one-day fall in 3 months. In the last 3 days, the BSE companies have erased market cap gains of the last 3 months. What led to the fall on Dalal Street? Will the IT sector recover in 2023? And why has Bajaj Finance's performance faltered? Hello and welcome to Editors Roundtable. I am Reema Tendulkar. With me are Prashant and Nimesh. Hi guys, it's just us and no Santa.
It's a bit quiet, right? Nimesh was telling us on closing bell that even dealing rooms are quieter. And participation here on this Editors Roundtable is also a bit thin.
As I said, it's just us and no Santa. It's more like Grinch.
The whole Santa rally has just been punctured.
I mean, no rally, right?
No rally at all.
The market is...
Forget rally. It's a brutal sell-off, you know. And this 1 week has just cleaned out most of the traders, most of those, you know, the so-called new savvy investors. I mean, they've all have taken a hit, not only in the trading portfolio, but even in the investment portfolio. It's been a brutal sell-off. The way mid-cap, small-cap has fallen sharply. I mean, individual stocks are down 20, 30, 40%. It's cleaned out. And a lot of the fraud, I believe, with this fall in this week, a lot of the fraud is out of the system.
And so that too in the last 2 days, right? Thursday and Friday.
Yeah.
The pace just picked up.
The ferocity of the sell-off, and no one saw it coming, right?
For a while, nothing was happening. I mean, the market would sell off and then it would get bought back.
Every depot is getting bought. You know, that was a very...
Exactly. Actually, the bigger question is, you know, is that texture changing, right? Because one gets so habituated with the feeling that only thing to do is just buy the dip, wait for the dip and buy the dip and you'll be okay. But I think on Thursday and Friday, it has not worked. So,
and you know, the other way to look at it is, Prashant, the whole of this year, we've been talking about retail inflows, that's supporting the Indian markets. That's the reason for India's outperformance. This week, panic was largely non-institutional, which means retail and HNI panic. You know, it's the other way of the other side of the coin now. We saw a lot of inflows and it was supporting the market, a withdrawal and panic, and we've seen such sharp sell-off in individual names, mid-cap stocks, small-cap stocks. So it cut both ways, right? That's what people say, that it cuts both ways. The flows cut you both ways. This week has really shown a lot of traders and dealers, traders and investors, that it cut both ways, and they've taken a sharp knock in this last.
Although reasons are still, I'm still wondering, you know, if you wanted to identify just this one reason, incrementally, what pushed things over, I'm not very sure there is that one reason, because the one answer, what I'm hearing, not as an answer but as a question mark, is it COVID-related fears, which is gripping the street?
COVID is used as an excuse, Prashant. This was coming.
Nimesh, I put this out on Tuesday morning. This is on Tuesday morning that, this China thing, etc. And I said, this is, and my idea was that maybe reopening trades, etc., take a bit of a backseat. But for that to be used as a broader excuse for a sell-off, I mean, I don't know. I mean, the situation in China is very different from what we have here. China is in its wave 2. They reopened after 3 years. We've gone through how many waves? 2, 3, 4. So I think, it's a very... Let me just quickly, for our viewers, round it up, right? I mean, the market, in terms of how things were. So, ferocious sell-off in the last 2 sessions, which is Thursday and Friday. The pace of the selling, I think, is what is unnerving for many out there. Both the 100 and the 100-day moving average, which is a longer-term trend line, that went away, that was broken. The 20-week moving average, that is also gone with the Friday sell-off, both gone on Friday. For the week, the mid-cap index down 6%, the small-cap index down 4%. Mid-cap index now for the year is negative, small-cap index is down over 20% for the year. This is, I mean, I don't know, I should call it silver lining or not, but the Nifty RSI, Relative Strength Index, is now 32. The lower bound usually gets to about 20, 25, and that's a signal that maybe things are getting too oversold. This is daily RSI, so it's not quite at the bottom, but, it just gives you a sign. The mid-cap RSI is under 30 now, so which again is a good thing, which is the fact that maybe in the very near term, things are getting a little oversold, which could mean a little bit of a bounce, right? I mean, I'm not saying that we got a big bounce ahead of us or anything of that sort. I think all of us know that 23 is a tough year, it's going to be a tough year, etc. But maybe with the 5% drop that we've had very quickly from the highs, from 18,887, which was the all-time high, to now. I think in the very near term, maybe as we end this year, they may be not that cheer, but maybe a little bit of a bounce, Rima.
Okay, so far at least it's eluded us, but half the dealing rooms are not there. So whoever you've spoken to, what's the feedback?
I think
the genesis of this fall?
I think this week there was still a lot of participation. Only towards the end, people have started going on. So my understanding is come next week, Hong Kong and Singapore, virtually nobody will be there. So that way it's going to be a muted week next week. But this week there was enough participation. The overall feedback. Y2D, the mid-cap index, has gone into the red. That's a big statement. That's a big news that people are in the last 1 week, the amount of money investors or traders have lost money in mid-cap and small cap is big. That's a big feedback. The index is down 6% this week, and Y2D, the mid-cap index, has fallen into the red. Again, what we are seeing is, this week we've seen a lot of fraud getting out in the mid-cap and small cap. Yes, we all know that the PSU bank index was the big outperformer, and there was a reason for the PSU banks to do well. But in the last leg, we saw, the last leg or the lower end of the PSU banks doing well. The float in those stocks like IOB and all is just 3%. And the traded volumes on those stocks were like 3x or 4x of what the actual volumes were. So that showed the kind of exuberance which was there, and that's now completely cleaned out. There are a lot of stocks within the defense names, the PSU bank stocks, PSU stocks. There was a bit of fraud build-up, and now that's cleaned up with this just 4 days of fall or the 5 days of fall that we've seen this week. Again, the big important point is one good data that I've looked for this year, calendar year 2022. Rima, if you look at global markets and in India, FIs have sold $200 billion in China. They've sold $43 billion in Taiwan, and FIs have sold $16 billion in India. And with this fall that we've seen, the markets have corrected, shaved off 5-6% from the top. The next year, early January, you're going to see the fresh allocation for the emerging markets, which will include India as well. So maybe the feedback is, while you might see a bit of a retail panic, I think this time the early start of next year could see that getting replaced by the FI money. So because they've sold so much, it looks like the FI money can come back in early 2023 if there is a fresh allocation for countries like India. And because of the correction now, valuations slightly have become little interesting as well, little attractive as well for the Indian market. So that's something one needs to watch out for. So the fresh allocation next year will be important. But the fact is, this week has seen the other side of retail money, wherein a lot of fraud got cleaned out, a lot of mid-cap and small cap. Traders have taken a lot of hit this week in terms of their trading position. So a lot of fraud is out of the way. But I guess next week could be a little softish. But I think the early January FI flow will be very important to watch out for, and that can set the tone for the Indian markets.
The PSU bank point, right? UCO Bank tripling in 3 months, I guess was the sign of things, right?
And this week down 20%.
The way investors were going down the curve now, that was giving a bit of an indication that there is a bit of fraud now.
I remember UCO used to have, of course, all of that has changed, but I still remember it just at one point had 20% gross NPAs. Yeah. Now, of course, there are different, but still tripling in 3 months. Yeah. It was just quite something. But, the one hope, Rima, that we have in 2023 is IT, because it is a large sector, it is down quite a bit. I spoke to Naren recently, who said that buy into a US recession and systematically buy IT stocks. But you have something for us.
Yes, so the Nifty IT index is down 25% this year. It's the biggest sectoral losers in our market so far this year. Right now, the question that a lot of people are asking is that have IT stocks corrected enough? Should one buy into the downturn? The downturn may last for the next 6 months, 3 months, 9 months, who knows, right? But is it now presenting an attractive opportunity, or do you think IT stocks can fall some more? So first, here are the numbers. This year, Nifty IT index is down 26%. But bear in mind that it comes on the back of 2 very solid years. In 2020 and in 2021, the Nifty IT index gave you a return of more than 50%. Now, I'm going to present 4 cases why IT stocks could weaken from here on, and 4 reasons why perhaps you should buy into the downturn, and then you can decide on which side of the fence you want to be on. So this is the bull and bear case on the IT. So first, number 1, we are talking about the bear case, right? CY23 budgets. CY23 budgets could get cut. CY23 budgets which get fixed in January could get delayed. There is also a risk that this time the tech budgets may be short term. the companies will decide their tech spend only for 3 months, 6 months, not for the full year. And there's also a risk, right, that if a company decides that I'm going to spend 5% on my technology budget in calendar year 2023, but my company's performance deteriorates as the year progresses, so my actual spend will be a lot lower than what I had initially planned for. So there is that divergence. Point number 2, the big elephant in the room is the US economy, right? There is a very strong correlation between the Nifty IT companies' growth and the US GDP growth. So if the US economy gets into a severe recession, a severe downturn, and then we could see EPS cuts. This is the Credit Suisse analysis. They're saying consensus expectation right now for FY24 is that the US real GDP growth is 0.6%. In that case, the Nifty IT companies will see a growth of 7.5%. But look at the bear case. If things go south and the US GDP growth gets into a deep recession, then the top line is going to get shaved off, and that will result in EPS cuts. Point number 3, premium valuations. Despite the derating that we've seen, Indian IT companies are still trading at a premium to the kind of premium they command over the rest of the markets and the pre-COVID average. And point number 4, mid-cap IT could be vulnerable. And this is on account of 2 possible reasons. One, they have a greater concentration of dependence on their large clients. So if one of those large clients gets into pressure, then their revenues are disproportionately impacted vis-a-vis a large cap IT companies whose revenue base is far more diversified. And 2, it's vendor consolidation. So this is the bear argument, right? But on the bull side, right, the bottom may not be formed just yet, but in the next 3 months, 6 months, things could get worse and one should buy into. So we are in the final stages of a downturn. Now, IT companies have been consistent wealth creators. This is the CAGR returns over 3 years, 5 years, and 10 years. And you would see, on an average, these companies have given you returns of 20%. Now, TCS, Infi, these are very large companies. The TCS top line is $25 billion. These companies cannot be replicated in a year. These are companies which have proven themselves in the digital transformation wave that is currently ongoing. Point number 3, IT companies have seen 1 year of a time correction, and 2, they've seen significant valuation derating, right? So as I said, we could be in the final stages of an IT downturn. And 4th, the cloud adoption and migration is a multi-year tailwind. It can slow down, perhaps in 2023, but it is something which cannot be reversed. So that is, the bull and bear argument for the Nifty IT space. Let's see how it performs. But back to you guys.
Rima, thanks very much for that. Very interesting. Let's jump from IT to the public sector companies, right? Yeah. Nimesh, and you put data out last week that maybe they're at a multi-decadal breakout level. And I think Motilal has followed up with an interesting report.
That's right. So, Prashant, before I talk about the PSUs and the PSA index, while the street is divided on the IT index, I mean, there are equal number of bulls and bears for IT for next year. That's what even Rima put out. But I think the one sector which is a consensus buy for many is the PSU index. I spoke about the breakout levels in the PSA index last week. Very interesting report from Motilal this week on the PSUs per se, and they are saying that the PSUs are scripting a comeback. Look at the number. The profit has tripled over FY20 to FY22 versus a flattish for the good 8 years between FY12 to FY20. In fact, this profit pool is largely led by the PSU banks. For the listed PSU universe, the profit CAGR for the last 5 years between FY17 to FY22 was 22.5% versus the private sector CAGR of just 14.5%. So the PSU companies have actually outperformed the private sector companies in the last 5 years, as per the Motilal report. In fact, Motilal also expects 8% earnings CAGR for the PSU basket, not only PSU banks, but for the overall PSU basket between FY22 and FY24. In fact, that's the numbers which Motilal is talking about. If you remember, Prashant, this week, Chris Wood had put out, the India, he's made some changes to the India portfolio, and he's added REC with a 4% weight. What was more striking was the fact that he's cut weights on blue chip names like HDFC Bank, ICICI Pru Life, ICICI Lombard, and has added REC. So PSU seems to be back in favor. There are technical reasons which we explained last week, and now there are fundamental reasons as well, explaining why the PSUs can make a very strong comeback purely from a fundamental point of view and from an earning point of view as well.
All right, Nimesh, thanks for that. So we've spoken about IT and PSUs as sectors. I want to talk about one particular stock, and this is Bajaj Finance. And I'll tell you why. This is interesting, right? I mean, Bajaj Finance is, if there is one name which is the absolute sort of top tier NBFCs, it is Bajaj Finance. Now, look at this headline, right? If things end like this, let's just go back to the first plate, please. If things end like this for Bajaj Finance, which is where the price is today, it will be the lowest return year, 2022, in the last 10 years. Bajaj Finance as of today's close is down about 8% for the year. Now, this is surprising, and this graphic will tell you why. The last time Bajaj Finance was down was in 2011. It was down 12%, and you can look at what has happened since. Just incredible run the stock has had, and this year, in 22, with a week to go, things can change, but I mean, I don't know how much, we're down 8% or so. So after 10 years, it's negative performance for Bajaj Finance. Now, this is what the stock has done, right? The lowest positive return for Bajaj Finance in that period has been 2013, which was 21%. The lowest return was 21%. Negative return years, of course, this year and 2011, as I said. And even with these two negative years, the CAGR since 2009 is 50%. I mean, this would rank in the top percentile. I think this would be number one or number two in terms of, you know, if you just look at the Nifty 50 stocks from the 2009 Nifty index and look at the constituents, this would be right up there. Now, these are valuations and how valuations for Bajaj Finance have moved. And, you know, you can see this step up, right? Every, 5 years, 6 years, the valuation moves up substantially and then it stays there. So in 2012, it was 1.8 times forward. This is all Bloomberg data. 2015, it moved up to 4 times. 1 year forward price to book. 2018, almost 7 times. It moved up to almost 8.5 times. This is, you know, in 2021. And right now, it's come off a little bit back to the 2017-18 kind of levels at about 6.48. But this is standalone valuation. We'll have to put this into perspective. But in any case, the current valuation is still much higher than the 12-year average of 4.5 odd times 1 year forward. Let's compare this to something, right? Now, what do we compare this to? Let's compare this to what is widely considered the highest quality top-tier bank, which is HDFC Bank, right? Now, this is Bajaj Finance and HDFC Bank. We spoke with JP Morgan's banking analyst who said that Bajaj Finance, and the reason, I mean, if you compare the stock price of Bajaj Finance and look at their AUM growth, they're very closely related, closely correlated. You know, the yellow one is Bajaj Finance, the yellow line is Bajaj Finance. You can see, for a while, the loan growth was head and shoulders above HDFC Bank. There was a dip, you know, during COVID period, and then it is picked up once again. This is F5. This, you know, this is the last FY21 data. 22, you know, there is data, but more importantly, look at FY24, which is what markets are focused on. Almost converging, right? HDFC Bank actually is at 26% estimated loan growth. Bajaj Finance is at 23 times. For 24, which is 1 year forward, HDFC Bank expected to do better than Bajaj Finance in terms of loan growth. Let's look at the other thing, which is profit after tax growth, PAT growth rate as well. Again, as you can see, Bajaj Finance head and shoulders above HDFC Bank for a while, right? This is the period of the valuation expansion. Sharp dip. I mean, HDFC Bank did not lose money during COVID. Bajaj Finance did report losses. And then there is a sharp recovery, which of course far exceeds what HDFC Bank has done. But here also, as you can see, there is some sort of a convergence. This is FY24 estimates. These are Goldman Sachs estimates. And FY24, Bajaj Finance is expected to grow profits of 19%, HDFC Bank of about 27% or so. So in both parameters, for 24 numbers, HDFC Bank still beating, you know, which is a much larger entity, by the way, to grow at that rate and beating Bajaj Finance, I mean, quite something. Now, this is valuation comparison for both, and I think this is the point which JP Morgan's Saurabh was making. You know, Bajaj Finance commanding premium valuations as compared to HDFC. At the peak, the number was about 172% premium over HDFC Bank's valuation. It's come off to 122 odd percent, but given the fact that valuations, and these are 1 year forward, given the fact that on both loan growth and profit after tax growth, you know, HDFC Bank is still behind, Bajaj Finance is still behind HDFC Bank for FY24. I mean, you know, would you want to pay that kind of a premium? I think this is the kind of question which the market will pay attention to. I just want to leave you with what next, a couple of points. Bajaj Finance saw loan growth slowing during COVID. It's picked up as we just showed you. Rate hike impact is not going to be as big because of the absolute high net interest margins. We saw that in the second quarter numbers which Bajaj Finance reported. There is a digital aspect of it, right? The app is already live, but the management has said the full app rollout will be by March of 23. It's expected to show up in a big way in 24 numbers. And of course, on the flip side, there is intense competition. As compared to 5 or 10 years back, the amount of competition from lenders of all kinds, fintechs, etc., is much higher. So are we in for a more normalized 25-30% growth rate for Bajaj Finance, or from the 40, 45, 50% growth that we've seen? Although I have to say, whoever over a longer period of time has bet against Bajaj Finance's performance has proved to be wrong. So history and empirical evidence points to the fact that maybe 23 we will see at least a better performance as compared to what we've seen this year so far. Back to you guys.
Very interesting, Prashant. We need to get into a very short break, but we'll continue talking about the markets. We'll also invite Mihir Vora, CIO of Max Life Insurance.